Let me start with an introduction for Jeremy. Most of you have heard Jeremy's name, quite some already, and I already did an introduction via LinkedIn as well. So a little bit about Jeremy. So Jeremy has started investing in real estate and business in 2002. He left the corporate world in 2007, and since then he has become a full-time passive cash flow investor, which is a concept not known to some of us, that he's investing full-time and living off the cash flow in his real estate efforts. And he's currently an investor in more than 60 opportunities across more than $1 billion worth of real estate and business assets. He's also a founder and president of the Bro Investment Group. Jeremy manages a group of 1,500 investors who seek passive and managed cash flow investments in real estate business. Jeremy is also co-founder for Investor by Investors, a nonprofit organization that was launched in 2007 with a goal of facilitating networking and learning among the real estate investors in a strict no sales pitch environment. So it's short for FIBI. That is now the largest public real estate investment meeting in California with over 30,000 members. Jeremy also has an MBA from the Wharton School, is a licensed California real estate broker, but only for investing purposes. He's also an advisor for Realty Mongo, the largest real estate crowdfunding platform in the U.S. So we really appreciate Jeremy here. I know he's busy, and I talked to him probably a little bit over more than once before this. So we have a few questions that we have wrote that in a Google Drive, and I just want to kind of start broad, giving everyone, I know a lot of us want to get into the details about cap rates and different things, but we also want to understand Jeremy a little bit as a person. So the first question is, what is your motivation to get into real estate investing and specifically passive investing? And we can move on kind of from the questions there. And for the other people, if you want to add on to questions, feel free to add to this Excel file that I'm going to share here so we can kind of go through and organize them. Okay.
All right. So Missy, am I good to go to answer that question?
Yes, you're good to go. Thank you.
Great.
Yes.
So thanks for everyone for attending. I really appreciate it. Happy to answer whatever is on everybody's mind. I started investing in passive cash flow back in 2002. And the reason why that happened is back in 2001, I was working in the corporate world. And after the dot-com crash, I was just sick and tired of the stock market. The two things that bothered me about the stock market were the volatility after the dot-com crash, but the lack of predictability of where my retirement account was going to be in like 10, 20, 30 years. I'm just a really slow, kind of low risk, slow and steady guy, and not understanding where things were going to be in 10 or 20 or 30 years just did not seem like a good retirement strategy to me. So I started to look at different ways to invest and kind of concluded that more predictable cash flow would be the best focus for me, and that I can get more predictability than the stock market returns. And it was just a really good comfort level for me looking on the lower risk side of things. So I started to rotate all my money from stocks and bonds into cash flow starting in 2002. And then by 2007, I ended up with the last strong moment in the corporate world. I was working at Toyota headquarters here in LA at the time. And I didn't intend to leave the corporate world, honestly, but I had enough passive cash flow built up to live off of. And so I took a risk and left the corporate world in 2007. And so since 2007, I've been a full-time passive cash flow investor. My number one goal is just to continue my cash flow stream and build it up so I never have to go back to the corporate world.
Yeah, that's awesome. And I recall you mentioning before that you started with just being able to break even expenses, and you recommended, for anyone else pursuing financial freedom, have a little cushion, not 100% income to expense, 100% cover, have a little cushion, maybe even 2 times. And I think right now you're trying to get to 3 times for you and your family, if I recall.
Yeah. I just want to say, when I left the corporate world, I had 2 times because I wanted to have some type of cushion. My ultimate goal was 3 times. I'm at 3 times now, which is nice, but it took a long time to get there. And of course, the more cushion you have, the better, because if anything ever was a great example is of the pandemic, right? Things can happen no matter how diversified you are. Not everything ends up working all the time. So it's really important to have the cushion.
Yes, definitely. And as a full-time investor, and I know some of us are active investors, some of us are probably considered more on the passive side because work is busy. You took kind of an interesting approach. You're passive, but you're full-time. So how passive is truly your passive investment, and how that can be different from any other passive investment in terms of investors, in terms of a time commitment standpoint?
Yeah. So I think that what makes my life really challenging that I'm in over 60 different things. I think if I was going to go into 10 or 20 things, my life would be a lot simpler. It's just not a good personality fit for me. I like the idea that I'm carved up into many things. I like getting exposure to many different things, even within real estate and outside of real estate. And so because I have that personality where I just want to kind of optimize, that makes it a lot more work for me than probably the average passive investor. So, as a passive investor, I do have some control over that. But frankly, I also hate turning down really good deals. And so depending on where we are in the cycle, that could be really hard. When you're like me, I'd rather carve more smaller pieces into more things than vice versa. So that makes my schedule much more challenging than a normal passive investor for sure. And, for anybody out there, I live in LA and I literally live 20 minutes away from the beach, but I don't think I have been to the beach in years. So, I work all day and night. I work very hard, harder than I did when I was in the corporate world. And that's because the pressure's on me from my family and just like any other entrepreneur, so to speak. And just one more note is that the work that I do is all up front, right? So I don't work any harder than a passive investor once I've sent my funding in. I monitor everything and I look at the quarterly payments or whatever, monthly payments or whatever in the reports. All my work is up front. But after a long time, when you're doing it as long as me, I have so many balls up in the air and things are constantly changing. Someone asked me before you came on, Missy, how many investments do I have exactly? And I said, literally, I cannot tell you because I had I've had about 4 cash outs in the last week and a half. I have another one coming next week. And then I have I actually have a spreadsheet where I actually only have upcoming for the next month, cash outs, redeployments, right? Just to track everything, how much money is coming in, how much is going out, what's my bank balance, everything else. So it's complicated, but I've kind of made it complicated to be honest, but it just works for me.
Got it. And another perspective would be good for us to get is why don't you go for the active side? What's the reason for that? Some of us here, we may want to go passive eventually when we have built up enough net worth, but some of us may just want to do active because we think it's better. But what's your perspective?
Yeah, so I started on the passive side out of necessity because I was in the corporate world and I was just way too busy. I was working at Disney headquarters, way too busy with my job to do anything active. And what I found is that I just really enjoyed being passive. And I basically trade control for diversification is what I tell people, is my opinion. And I feel like I would not enjoy being active. I wouldn't enjoy all the work and what's involved in being active versus passive. I love looking at deals, finding deals, vetting deals, and then getting into them. I love it, but I wouldn't enjoy being active. So for anyone who's active right now who wants to eventually become passive, the one thing I would say is that I really personally have come to the conclusion that active versus passive is often a personality fit, and talking to hundreds or thousands of people about this topic over the years. And so I would just caution you that if you like having control or you want the extra returns, or you want to only invest within 20 miles of your house, or whatever the reason is that you're active, passive may or may not be a good fit for you, even if it sounds good, just for your personality. So just make sure you take stock of your personality, because I think the number one thing to consider is whether it's the right personality fit for you.
Got it. And I want to kind of toss things around and ask a few questions that just been added. One good thing that I would maybe good to ask right now, and I'll ask these 2 questions together because they're similar, is what do you look for in a deal to make a decision if you're going to invest in a deal? And what is the critical information you expect investors to provide you with a deal?
Yeah. Okay. So we talked a little bit before, for those of you who are on, about, what I'm looking for today, but high level, I'm just going to say that the highest level possible. I'm looking for someone who's conservative as a sponsor, who's going to underpromise and overdeliver by using conservative assumptions, just because they're trying to build long-term relations with investors, overperform, and keep me as an investor on for decades. What I'm trying to avoid is someone who's using really interesting numbers and very aggressive numbers to make the numbers look good and be attractive to attractive investors, but may actually underperform, but is more of a marketing machine and doesn't really care whether I invest, because they'll just go on to the next investor. All they care about is closing the deal today, right? And both of those exist. And so high level, I'm really looking for someone who's conservative, because that fits my personality and also I think sets the right expectations. Answering the question a little more detailed, it depends on the asset class in terms of, I invest across most of the major asset classes in terms of exactly what I'm looking for. But I personally, just to give you guys an idea, I typically invest in a Class B asset in an A- or B location outside of California for better cap rates and better cash flow. And I avoid very volatile markets like, Los Angeles, San Francisco, and New York. I also avoid very hot markets where the cap rates have already been really brought down and therefore the cash flow isn't as attractive, because I don't want to chase a market. I want to either be behind, like in advance of a market, or just be in a more stable, predictable situation. Keep in mind, I invest one way. There's 1,000 ways to invest. None of them are wrong, but I tend to just look for more predictable, stable cash flow. So it's got to match my criteria.
Got it. And another question is, when you're looking for those operators, investors, how do you identify the ones that could be successful? You talked about the experience piece, the conservative piece, and I know some of the people who are on the active side, they're starting and they don't have the experience. They may be partnering with other people who have the experience. Are you willing and open to look at those? And how about the fund-to-fund model that some of us either participating actively or passively? How do you see those models?
Yeah, sure. So the first thing I'll say is I tend to be pretty strict about not investing with somebody until they've done, I don't know how I ever came up with this number, but I like to they've already done at least 7 deals as my comfort level. If I meet someone who's on their first or second or third deal and I find them interesting in what they're doing, a good fit for me potentially, I'll ask to be added to their distribution list, and then I will monitor them until they get a few more deals down the road and see how things have been going. As far as partnering with a more experienced sponsor, I think that could be really helpful for a lot of people to get off the ground. It doesn't change my 7 deal thing for myself, especially if they're actually, either actively managing the property themselves or even managing the third-party property manager. But that's just a rule that I have personally. And then as far as the fund-to-fund models, I don't typically invest in a fund of funds. And the reason is because I am a full-time investor. And what that means is the onus is on me to network and actually find the sponsors directly, because in a fund of funds, there's an intermediary, and by definition, I'm getting a lower return for an equal amount of risk, right? Unless something is happening with the fund manager that they're able to manage the other actual sponsor somehow, and actually are adding value for the lower return. I think it's a really good fit for people who are very busy, who are working, who don't have time to network and find deals. But because I have the time, it doesn't make sense for me to go through an intermediary when I full-time try to just go direct to the sponsors.
Yeah, and I think it depends. There is some fund-to-fund that's lower returns, but I also I'm trying to look for the ones that offers a different class shares. So it's going to be about the same or slightly more favorable if the investors invest through the fund-to-fund model. But I think a lot of them,
yes, yeah, Missy, to your point, if someone isn't taking a spread and they've negotiated something with the sponsor directly, then it's effectively like going through the sponsor. I will say that if there's a choice of going through the fund of funds or going direct to the sponsor, I'll always take direct to the sponsor, even though the returns are identical, just so I'm direct to the sponsor. I get the reports from the sponsor and I have access to the sponsor, even especially during the due diligence and vetting period. But you're right, there are some fund of funds that are structured better than others from an investor perspective, for sure.
Yeah, understand. And another question, we'll have a lot of great questions coming, so I'm just going to keep throwing to you, okay?
Sure.
I know you're a conservative investor. Given the current environment, are you participating in less deals, or are you becoming less conservative compared to 1 or 2 years ago? And just a second, and I know you also invest not just in multifamily, you diversify across. So maybe also talk about how did you get a good understanding across all this different asset class and feel confident in it, right? It's kind of all in together.
Sure. Well, for the first answer is I just end up investing less, right? I don't get more aggressive. It's the one thing that I really try to hold my ground on is not increase my risk at the end of a cycle. I've been through, the previous cycle. There's going to be another cycle. Cycles, in my opinion, haven't ended. So we're going to have another adjustment at some point. And I try to be really careful with it. Again, because of the fact that I don't get the major value add deals, especially not at the end of a cycle, I have to be really careful with the basis. And when the basis gets too high, I tend to sit on the sidelines, except for unique situations. Sorry, what was the second question?
Yeah, how you diversify across like ATM funds and blah, 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 different funds.
Yeah, so one of the advantages I have over a lot of past investors, I have 20 years, it'll be 20 years in February, so I have a lot of time. And so when I started, the way I learned all this was 2 different ways. One is you focus on one asset class first. And I tell people, most people frankly prefer to focus on apartments first because they've either lived in them or they understand them or both. And so it's a good place to start. There's also probably the most apartment deals of any asset class period, because if you think of a city, there's just a ton of apartments. And the ratio of, let's say, apartments to self-storage units is a very big ratio, right? So there's a lot of access to deals. And then learn that first asset class. as best as you can. And then I would say about 80%, typically just a random number, of what you learn is then transferable to the next asset class, because there's still going to be revenues, there's still going to be expenses, there's still going to be a debt coverage ratio, there's still going to be a cap rate, there's still going to be all kinds of other things that are similar. So, revenue and expense increase assumptions and all the rest. So I would recommend focusing on one asset class first and then going to different asset classes. There's two ways that I learned, though, primarily myself, and this is way back, when there wasn't as much stuff online. I went to a lot of in-person meetings here in Los Angeles. Being in a big city, I had the ability to do so, and I really spent a lot of time. I went to probably 2-3 meetings a year before I had kids. Sorry, a week before I had kids. I was driving, a lot of driving, and I would go to panels and listen to panels of speakers on the exact asset class that interested me, and I'd learn a lot like that. And then eventually, I got into some opportunity exposure. What I would do is, you could do this really easily today. You go into some crowdfunding site and you can download 20 apartment opportunities or across all of them in your pajamas, and you put them all next to each other and you say, what's similar between all these? What are different? Why is this person's preferred return of 5% and this person's 10? Why is this expense ratio 50 and this one's 30? And then you start to learn where the commonalities are and where the variances are, and then you start to really hone in on what you're supposed to be looking at. So opportunity exposure was a really big help for me. It just takes a lot of work.
Got it. And some more specific questions kind of going along with this cycle. What kind of cash on cash are you looking for now, and what payment intervals do you expect? Mm-hmm.
Yeah. So what I would tell people is that, and I mentioned this earlier on for those of you who are here, is that I'm not looking for specific cash on cash today because the cycle hasn't reset and I don't know what I should be targeting. I think that I had a target at the beginning of the cycle, and I'll tell you what it was back in 09 and 10, which is Class B asset in a kind of a B market, 9% year one cash flow and 11% average annualized projected cash flow net to investors. The problem right now is that that's unrealistic. You're typically going to find between 6 and 7, maybe 8% cash flow year one for investors right now. And what that does is it tells me to be on the sidelines, right? Because it means that assets are too expensive. The deal I mentioned as an example before we started was yielding about 9% cash flow year one on a Class A asset. That's highly unusual, but so is a deal, right? So that's very hard to pass up in today's environment. But I have no specific target at the moment because I'm really on the sidelines for most deals at the moment.
Got it. So are you, if this is too personal, just let me know, is your money just sitting in the bank or are you investing some other places? If so, where are you investing? Asset class and markets based on the cycle we're in today.
Yeah, sure. So look, I have 3 buckets I'm considering seriously right now. One of them we've already discussed, which is very unique opportunities like the tax abatement and low-income housing tax credit apartment deals. The second bucket would be short-term opportunities that I think have a very high probability of exiting, and that gives me some working of my cash instead of sitting, but that's going to come back relatively quickly so I can go and redeploy it if and when there's an adjustment in the market. Really great example. Hard money lending. I always do hard money lending on single family flips like first position loans. And boy, was that favorable for investors this year. I did 2.5 times more hard money lending than I normally do in a year because, the supply and demand was so out of balance in the markets. And of course, as we all know, single family prices were just skyrocketing. So it was a very, very good investor risk reward scenario. And I actually have a call next week with my primary person I do this with to kind of brainstorm what am I going to do next year with this. I'm definitely going to tone it down, but I don't know how much compared to normal. But that's another great example where it's short-term type of opportunity, and where I think it's good risk reward and low risk in terms of getting your capital back. And the third bucket is opportunities where I don't have to worry about asset depreciation. So that's my number one concern right now is what happens if I invest in an apartment building today and the cap rates go up 200 basis points in the next 2 years because interest rates go up. So that's a very big concern of mine. And so you mentioned ATMs before, Missy. I've been investing in ATMs since 2008. And the one thing I don't have to worry about at all is I know my ATM machines are depreciating to zero. I don't care if it happens, if they're worth less next year or in 3 years, that's happening anyway, right? Because it's a longer term deal. So if I look at that scenario, I care more about the predictability of the actual transaction volume that generates the revenue as opposed to the asset value. And so right now I'm very concerned about asset values, but if I can get into deals that have more predictable cash flow, or I don't have to worry about the asset value, then I'll definitely seriously consider them. So I've done a good amount of ATM investing this year as an example, but I have those three buckets right now, and any of those can make sense for me at the moment. So.
Mhm. Yeah, thank you, Jeremy. I think the perspectives you offer for some of the active investors, especially when we're dealing with other investors, it's things we need to warn them about, like, how our investment opportunity could possibly be helping with those next cycle coming. What are we doing in place to help with that? You mentioned about the short-term opportunities. That's what you're investing. Last time we talked about investing some of this multifamily deals that has a longer term loan so that we don't have to exit at a time that the market is bad. We can have more flexibility. Is that a little contradictory, or you're just seeing it as a different risk profile for your portfolio?
Well, so in the deals I mentioned that are unique, my other criteria that's required is not just unique, but if someone brings me a unique opportunity, a real estate deal, but has a 3-year loan as an example, I'd probably pass. I mean, almost certainly pass, no matter how unique it is, because I'd be concerned about adjustments in the market in the meantime, and then us being in a position where we're on a very strict timeline to exit or refi or sell. So I typically prefer longer term loans, even in normal times, because it provides more predictability for me based on it, assuming it's fixed rate. And because we have more time to amortize the loan, pay down the principal, and be in a better position should, let's say, rents not pick up as much as we think, et cetera, in the 10-year period. So that actually, Missy, wasn't a current thing for me. It's an always thing for me.
Okay. So if that's always thing, and you have the short-term investment opportunity, you talked about some of the fix and flip, I think you mentioned earlier, things like that. How does that, is that just a way to balance your portfolio? Because they seem to be contradictory.
Oh, right. Okay. So no, so that falls into one of the three buckets I mentioned. So one of the buckets is short-term things that I think have a very high probability of not having any type of exit problem, right? So to me, the risk reward makes a lot of sense on the single family flips over the past year because prices are skyrocketing, et cetera. But I'm always doing a mix of short-term and long-term stuff, always. I prefer long-term stuff. I frankly prefer a 10-year apartment deal with a highly diversified tenant base with an experienced sponsor because I'm looking for that longer-term predictable cash flow. And for me to have to go redeploy money every year is more work, right? But I'm always doing a mix of everything for diversification, and frankly, because I think a lot of the short-term stuff can make a lot of sense at times. So it's for all those reasons.
Okay, that's good to know your strategy on that area. There is another person asking, kind of related to the market cycle. So everyone has been wary of investing because they believe we're at the end of the cycle. But do you believe you have missed on opportunities?
Yeah, well, no, look, there's absolutely no doubt that I missed on certain opportunities. But I've also pivoted and done a lot of other things in its place. I haven't done as much volume as I would have liked, and I haven't done as much volume as normal. So I do have more cash sitting than I'd like, to be honest. I think that if you ask me that question again in 2 years, I'm going to have a different answer. Meaning that I think the answer today, I mean, if you look back between 05 and 08, I sat on the sidelines and I was I was much younger. I was going to a dinner party with my friends, and I'm warning everybody there's going to be a housing crash, and they all think I was nuts. Okay. And it was really tough because I'm listening to this for like years. At this point, I've been in the sidelines since the beginning of 2017 because I'm into cycle timing and asset prices, except for these unique situations. And it's been even longer than last time. And it's been tough. But what I've had to do is pivot and look at these different buckets that I mentioned. And I still find stuff. It just becomes much harder. So I definitely still capitalize on specific opportunities. But the problem is that, like, the timing you're asking me this question, like if you ask me, are you in 2008 in January, you say to me, aren't you like, didn't you miss out on all these deals in 05, 06, and 07? I would say so far, yes. But then if you ask me in 2010, I'd say, no, I didn't. Look what happened. So that's why I'm saying, talk to me in 2 years from now, and I'm going to have a different answer.
Okay, got it. And the next few questions are more surrounding about your experience as a passive investor. Like, what are some of the common objections you hear from other passive investors about investing in syndications now, since you network with so many of them?
Sure.
And what's your worst experience as a passive investor?
Yeah. So common objections are just, I think, going to be obvious to a lot of people, which is current market pricing, lower returns, right? That's always a challenge right now. Is the 3+1+1 bridge loan safe? where's that going to end up? What's going on with interest rates? Like, do I need to wait because interest rates may go up, and how's that going to impact properties? And those are some of the common things that I hear, and it makes sense right now, I think. And I'm sorry, what was the other question?
What's your worst experience as a passive investor?
Yeah, I've had two particularly bad experiences. One is I invested in a portfolio of kind of single family buy and hold 5-year strategy in 2012 and 13. Timing was really good, but there were two partners that I knew really well who actually were the ones who were executing. They had a partner dispute with the back office guy, and they got up and left, and they just left all the investors. And so the back office guy really didn't know what he was doing. So I had to kind of step in on behalf of everybody and we had to negotiate getting this back office guy who didn't know what he was doing, he was mismanaging everything, to give us the assets in exchange for us not pursuing him because he was mismanaging everything. And I found someone else who was an experienced operator to come in, clean everything up and sell everything off. And we ended up about break even, which is, not a horrible outcome, but when you're in it for 5 years and you've got no return, it's not a good outcome, especially with inflation. But that was definitely quite an experience. The other is that I've invested with a sponsor for a long time in many opportunities, and there were 3 partners. It was a father and 2 sons. The father, unfortunately, was found in the last couple of years to be taking small amounts of money out of reserves across, 11, 12 properties. That was not noticeable because it wasn't big amounts, but it caught up with him. And so that ended up in like the hand of a receiver to protect the investors. Now they found a new sponsor. It's been a transitionary period. We're still just finalizing. So watching all that happen because it stopped cash flow for a couple of years has been really tough. On the other hand, everything's still been managed well. And so we're going to be fine as investors, but being the victim of, I guess, fraud, minor fraud, and very manageable fraud, but fraud nonetheless has not been fun. But the problem as a passive investor is once you go into enough deals, it's impossible to bat 1,000. It's really impossible.
Mm-hmm. Yeah, and I guess that process and experience probably made you a way better investor from there. It was an expensive learning experience. And I know that you shared that on some of the calls, like the Zoom at 8, which I'll pin the link here for anyone who didn't, watch that meeting. Check out that YouTube recording of Jeremy sharing about how he does due diligence on his operators. So that might give you a better idea on how to become better on yourself or when you check out other people's deals. Yes. Yeah, and we're still good on time. We'll have a question on about how do you receive deal flows, similar to what we're talking about now.
Yeah, so with the advent of the 506c structure for public marketing to accredited investors, it's become a little easier to find opportunities over the years. But frankly, the vast majority of deals I still find and go into are all private. They're 506b, not allowed to be marketed to other investors. So my day is spent networking with other investors, sponsors, and investor groups to try to find opportunities. And so it's all about networking. I've done 20 years of networking, so now that I had a lot of time, I have a big network, so it's easier. But it's all about networking. That's the number one thing that's required from a passive investor perspective.
Mm-hmm. And so for new investors, what do you believe is the fastest way to get into the real estate investing game?
Yeah, so it's funny because I mentioned it's all about networking, but if you're a new investor and you're willing to go through an intermediary, right? You have crowdfunding platforms, you have investor groups. Both of them will give you a lot of deal flow and you'll be able to get in very quickly. Now, whether or not you'll want to go into those deals is a different story. That's very subjective. That's up to you. But if you want a lot of deal flow quickly, go onto the crowdfunding websites and try to find some of the investor groups. There's a lot more than there were even 5 years ago. They do find a lot of deal flow. And if you're busy and you can't find deals or you don't want to take the time to network, they provide a really good service. They just happen to be that they're taking a portion of profits in exchange for their work, and that's fine. And so you'll find a lot of deals in those two sources.
Got it. And I believe that's probably one of the easiest ways as well, right?
Yeah.
Okay. And another question is on what are the top mistakes you see real estate syndicators make? You talked about underwriting conservatively. Anything else?
Yes, there's another one that I think is just a really bad mistake sometimes. And also tells me a lot about the sponsor. Once in a while, I'll see a deal, especially a larger fund, where it starts off with terms that aren't the best for investors. The sponsor is trying to get the best terms they can. And then if they can't raise the money they need, they may change the terms, right? So they may give a better split. They may change the preferred return. It may be fees, whatever it is, right? The problem with that strategy is twofold. One is that what it tells me as an investor and reading between the lines is that I'm dealing with someone who isn't looking to kind of make it a win-win for investors and the sponsor. They're trying to get the most returns possible for themselves. And I'm not sure that I want to necessarily partner or make a bet on somebody who's looking out for themselves more than the investors, or at least not the same amount, right? So the mindset there is more of a scarcity instead of abundance. And that bothers me a lot. If I see somebody do that, most of the time, they're automatically on my blacklist. I'll never, ever consider a deal from them, no matter what the structure is. And so even if I get it after the fact and I see it in the better splits, if I find out that it was the worst splits before, it's just not a good personality fit and mentality fit for me. And I think that's very detrimental. And I think the other half of that is that with the advent of some of the investor groups and just even like you guys who exchange information and post things online, it's very hard to hide from those types of issues today compared to even 5 years ago. And so I think that it's critical for a sponsor to consider the strategy they're taking going in on setting their terms and everything, because it can be really detrimental to a sponsor's reputation if they try to do that type of thing.
Got it. And kind of a separate question to get into another track. What's your thoughts on build to rent, especially in this cycle of the market?
Sorry,
it's getting really hot. Build to rent.
Build to rent. So my thought on build to rent in general is that it's actually meeting an important demand that's probably going to be there for a long time. With the cost of housing continue to go up, with people's wages, not keeping up with inflation, and rents and house prices going up much faster than inflation, there's probably going to be a good amount of demand. And in some ways, it's not necessarily affordable housing, depending on how it's positioned. Some of it is, but it's more meeting. It's providing a solution for people, and that's really good. And I think that problem's going to be there for a long time. The challenge I have with it at this exact timing is just market pricing, whether it's construction cost, whether it's the cost of the land, the cost of materials. Land is a very volatile asset, meaning that it can go down and up a lot over a cycle, and it goes down very quickly in a downturn. It loses a lot of its value very immediately. And so my argument would be it is dangerous to buy land at the end of a cycle when it's got its highest pricing. And so I like the strategy. I don't like the timing.
I see. So I guess you don't invest in any of those yourself today, or very minimal.
Not today. Certainly wouldn't rule it out in the future, but not right now.
I see. And kind of going along with another question from earlier, you mentioned about people increasing their returns later. So from a professional passive investor standpoint, would you get excited if you see a 12% pref, or would that be a red flag for you? It's a question from the audience.
Yeah, so be able to answer that question, I'd have to have a lot more details. I need to know what type of asset is it, what is the cap rate, is that a preferred equity structure or just a straight up common equity structure as a preferred return? Are there splits or not? What does the rest of the capital stack look like? If it's a preferred equity, what is the percentage of debt? What is the percentage of common equity? So unfortunately, without more details, I can't really answer that question. If the person posts the additional information, I could definitely answer it.
Okay, cool. Whoever shared, if you posted that question, if you want to come out of the microphone and share. I think on the questions we have now, we just have one question that, left. So if you want to come on and ask Jeremy, you can. Otherwise, I can go towards the next question. We'll just open up for open Q&A. Okay. Kind of the question I had was, what's the long-term vision for you and your company from an investment perspective? Because you got an interesting model going on, and you have a big following, and you have a great network. I'm curious, where are you taking this next?
Yeah, I mean, look, to be honest, where I'm taking it next is I can't wait for the cycle to reset. We'll see what happens. Maybe prices will change, maybe they won't. But the challenge I've had now since 2017 has been uncomfortable with doing normal market rate deals, which, in 2010 and 11 to 12, it's very easy to get comfortable with doing market rate deals. And so I really am looking forward to the cycle resetting and where I can get back into a higher volume of investing. and just do more investing. So it's pretty much more the same for me, but I'm hoping that the shackles are going to come off at some point, in that I'll feel comfortable finally moving forward and getting all of this uncertainty and lack of predictability out of the way. So that's my plan. Just continue on with the same.
Yeah, cool. Makes sense to me. Okay, we got another question. I hope you drank enough water, Jeremy. Going through this like drinking from the fire hose. What are you doing to hedge against the downturn? I think you mentioned about the 3 buckets.
Yes, it's those 3 buckets. Plus, I've actually pushed a lot of my sponsors to sell in 17, 18, 19, and 20. So I've been in over 30 exits in the last 3-4 years, maybe 4 years. And I continue to be in the odd exit here and there. And frankly, every time I'm in an exit, like I'm actually waiting right now on a potential exit of a large mobile home park fund that I'm in. And they kind of been considering it. They've been pushing it off. And I'm like, oh my God, like I feel like it's just a race against the clock. And so, I get happy now when I hear that I'm actually getting an exit. I just got a very big self-storage exit last week that I'm hoping to get the cash from for the end of the year. I'm very, very excited about that. We captured an amazing cap rate. And so, that's kind of where I stand with everything. Mm-hmm. So it's those 3 buckets plus pushing the sponsors to sell and just waiting until we get more clarity and more predictability.
Yeah, that's interesting when you talk about pushing the sponsor to sell. Like, are you investing a large amount that it's like a good enough leverage against them, or are you saying, no, I'm Jeremy Rowe, therefore you have to listen to me?
No, no one has to listen to me ever. And the truth of the matter is a lot of them don't, and I don't expect them to, but I try, right? And so there's 2 things that I do, 2 different strategies I have. First is I tend to stay in close touch with a lot of sponsors I invest in, probably more close than most of the less active passive investors, so to speak. And so I will kind of put hints in their ear. Like in 2017, I'm like, hey, the cap rates are getting high. What do you think, right? And then no, we want to optimize the property. Okay, a year later, right? Oh, the cap rates are even higher than we talked about before. Don't you think it's a good time to sell? And I just keep asking them about it. Not too often, not bothering them, but at least once or twice a year. And I might even throw some economic data their way. I might send them an article as to like what's going on in the industry and why I think, it's so important, that type of thing, but very, very low key. The last thing I want to do is be a bother to, and I'm very, very, very careful with that. So that's one strategy I take. And sometimes you can get someone over the edge, and they kind of eventually agree. The other thing is when I do invest through my investor group, then we do have, a little bit more, I don't know if clout is the right word, but if the sponsor thinks that everybody has a similar opinion, and a few of the investors start asking for the same thing, sometimes they can actually make it happen. But in the end of the day, it's very important to understand that we don't have any control beyond more control than our actual vote. Our votes are all very small, and the sponsor has control. And frankly, they're professional, they're the expert, they should have control. And we're just making a bet on them to make the best decision. So I give it an opinion, but that's about the most I can do, right? And that's mm-hmm. about it.
Mm-hmm. Yeah, good perspective. Okay, another question came in. What is your structure for the investor group process?
Yeah, sure. So I don't normally talk about my investor group because I try to avoid like public solicitation. I mean, I know it's the private type of thing, but still. But I'll answer the question. So the structure is it's a mailing list. I send a very small subset of what I'm investing into my group, and people can choose to invest directly with the sponsor under the exact same terms as me. I don't pull anybody together into an LLC. People invest directly with, into the sponsor's opportunity and interface directly with the sponsor. And so anyone who wants more information about that, they could just email me. That's not supposed to be an ad. I don't want to get into too much more detail because I don't normally discuss it. So
understand. Okay. I think that's all the questions we have. Anybody else, you're welcome to come on mic, open up your mic and ask. I know it's a lot of great information you've shared today, Jeremy. Okay, I have a question. So you invested over 60 syndications, maybe more if you actually count them. How many of them are sponsored teams are there? Is that like a 80-20 rule? Would you say you're investing mostly with like 8 teams or?
Yeah, great question. And it's been actually probably over 100 or 150 because the 60 is what I'm in right now, but we've been doing this 20 years, so things constantly change. So what I would say is that I try to hold to a couple different rules. First rule is the concept of having more than 5% of my net worth, and definitely not more than 10% of my net worth with one sponsor, is definitely important to me. And I prefer to keep it under 5% total. And actually, sometimes I have a challenge where, for example, I'm currently in about, I don't remember the exact number, call it 10 to 13 active deals with one sponsor. And they keep having these great deals. And now I'm just cutting my amount down less and less and less because I still want to get the diversification. I don't want to miss the deal, but I don't want to get overexposed to one sponsor. So, but that's rare that I actually am in that position where I'm seeing so many deals from one sponsor and I happen to like them all because I'm usually very picky. And so anyway, so that's kind of how I work, and that's kind of the hard number that I tried to put a line on. And so I couldn't tell you the exact number of sponsors on it. I have to look at all my K1s and figure it out because to me, it's not that important. What's more important is I don't have too much cash with one sponsor. I'm not trying to target a number of sponsors. It's just not to be too heavy with one sponsor. So.
Got it. I think that's all my questions, and some of the questions were listed. I'm just going to pause here for anybody else to ask. We have 5 minutes. Is it possible we asked other questions? The questions kept coming.
I know there was a lot of questions at the very beginning, so this is your opportunity to, again, ask Jeremy anything. I know there's a lot of people in here right now, Jeremy, that are in a similar position that you were when you started out, that are interested in raising capital and kind of best practices. If you were starting over today, would you do anything differently, especially considering social media and the internet and all the things that are available to us today?
Yeah, so I'll answer that from an active and passive side just to try to help everybody. So let me just start on the passive side. If I was starting out today on the passive side, I would absolutely take advantage of the current environment in which a lot of in-person meetings that I went to when I was younger to learn are now actually online on meetup.com and other sources. And I would fully try to take advantage of the fact that you don't even have to put your camera on, right? So you could sit in your pajamas. I mean, it boggles my mind that you could, like, I'm in LA. I can log on to a meeting in New York City that's at 7 p.m. at 4 p.m. my time, log off of that meeting an hour and a half later, log on to a meeting in Chicago, log off of that meeting, log on to another meeting in LA. And I've literally been to 3 meetings in one night. I haven't moved from my chair, right? Except for maybe to go to the restroom. And like the efficiency behind that compared to what I had to go through in the traffic in LA, et cetera, is mind boggling. And the amount of education you can get is just exponential because of that. And you could do that every day, probably 5 days a week, right? If you wanted to. So I would strongly recommend using that. Podcasts, fantastic resources of information. You can cherry pick topics that you want to listen to, and there's literally too many episodes for you to listen to, period, right? I mean, I've been on over 100 podcasts myself as a guest, but there's podcasts that have over 2,000 episodes, and they're just call it unlimited amount of content, practically speaking, and you can learn a ton just on one asset class or multiple asset classes like that. So those two sources alone, I think, are more education than anybody could even potentially get through, and they're free. But actually, I shouldn't say that. A lot of the online meetings are free. Some of them are paid. But the point is they're just very, very great education and very efficient. So that's what I'd recommend on the passive side if you're just starting. On the active side, I'd recommend that you consider running either a meeting, whether it's virtual or in person, maybe once a month to just bring investors together. And it should not be a sales pitch. It should not be focused on your business. It should be a topic that interests you, that maybe is relevant to your business. But say you're apartment syndicator, passive and apartment investors unite, or even just apartment investors unite, and it'll be active and passive. And now you're helping the community, helping everybody to learn, and you're going to network and find some investors, find some deals, et cetera, over time, right? I just strongly believe in the no sales pitch philosophy, so that's very important. And you can do that extremely efficiently now and have an only virtual meeting, never have to pay for a room, and get a national audience versus the audience that we have here with for investors by investors in person in LA specific for most of our, in Southern California for most of our meetings. And you also may want to consider starting a podcast, adding a lot of value to the community by helping people to learn, and then you get exposure yourself and network a lot with a lot of great people and learn a lot too. And so those are just some suggestions. If you're just starting on the active side, all these things are work, but the opportunities are there that if you're willing to put the time and work in, you'll get the rewards and really help a lot of people at the same time. And so technology has really been helpful and made things much more efficient as a very different thing than when I started.
Has that changed your plans for 2022 in regard to the in-person conferences and meetups? Because I know that you're asked to go to a lot of conferences.
Yeah, so in 2021, I probably would have been a speaker or panelist at about 5 or so meetings in person that I just didn't go to because of COVID. Most of them were in the fall, and I really am still upset about that. I just hate missing good opportunities to network and everything else. I am hoping to be back in in-person meetings as of January. I actually, through Foreign Investors and My Investors, we co-host Intelligent Investors Real Estate Conference, IIREC, in LA. That's towards the end of January. And then I'm also currently scheduled to speak at the Best Ever Conference in February in Denver. And then we'll have to see what happens. I am very low risk. My son had a very bad challenge with the virus many, many years ago, and now is higher risk for COVID. So I have to be personally very careful. But I actually, Jim, I think that the conferences are going to ramp up a lot in person this year. I think there is pent up demand. And I can tell you, I'm probably not supposed to say this, but I know Ben, the organizer of the Best Ever Conference, very well. He is way ahead of schedule on ticket sales. He's probably the largest conference I could think of, and he's even ahead of ticket sales at this timing normally. So it's probably going to be a fantastic turnout there. I'm hoping to go to a lot of in-person meetings again. It's been a long time.
Awesome. I think there is a ask from Jeff, and I think probably a lot of us are wondering too. Are you willing to share a list of some of the deal sponsors you have high level of confidence in? You don't have to share public if you don't want. You could just follow up afterwards.
Yeah, the people can follow up me directly if they want. But why I'm hesitant to do that at this particular timing is because I'm not investing in 99.9% of deals, right? And so the really good sponsors that I know that I like, a lot of them are just on the sidelines. And so, if you're looking for someone to invest in today and you have to get 5 deals from them, I would tell you, the more deals that somebody did in 2021 it actually is inversely proportional to the likelihood I'm ever going to invest with them, because just the difference in opinion of timing, right? So someone did 20 deals in 2021 as an apartment syndicator, there's probably almost a 0% probability I'll ever invest with them because we're not on the same page. And I'm not saying they're wrong, we're just not on the same page. And so it's not the right fit for me. And so it's very hard for me to recommend any sponsors right now. And I get this question a lot, because if I recommend someone to somebody I'm not going to invest in today, but they're doing a lot of deals, it doesn't make sense. Like, I'm not going to invest someone I'm not investing with, recommend someone I'm not investing with. So it's a tough question. I could take it offline with some people if you want, but you're probably going to get a very similar answer to me. I'm very careful with referrals. I usually only mention sponsors that I've invested with many times before, and right now I'm barely doing any investing. So
makes sense. Cool. Well, we're a few minutes over, but really thank you for your time, Jeremy, and for speaking so quickly and also attentively answering all our questions. Really
no problem. Look, I just hope it was helpful for everybody. I appreciate everybody taking their time here to attend.
Yeah, I'll be uploading a recording this week, so those that couldn't make it due to technical issues can get to it as well. Yeah.
Sounds good. Well, thanks again for having me on. I appreciate it.
Yeah, thank you, Jeremy. Thank you, Jim. Thanks, everyone.
Yeah, second that motion, Jeremy. Thank you so much. We're always very grateful for your time.
Absolutely. Thanks, Jim.
Yep. It's good to see you again.